Hello, everybody. This is Heidi Hicketh here with the Emmanuel Foundation, and I have our panelists, our fabulous panelists here with us today. I just wanted to welcome everybody. You are all givers. And so one thing we thought that we could do as for our philanthropists out there is give you some little pointers, things that maybe you didn't consider, because as you know, giving does have some tax advantages. And so we've got a brain trust here. I mean, these people are super smart, and so they have a lot of great information. So let's just start with Erica Johnson, and we'll do a roundtable. Everybody's going to introduce themselves really quickly, and then we'll get started. Erica?
Okay. Oh, goodness. Thank you. Erica Johnson, and I am an attorney at Measure Law Office in Kalispell, Montana, mainly practicing in estate planning, business planning, and a smattering of little other things. So I'm happy to be here. Thanks for inviting me.
All right. Bryson.
Hi, I'm Bryson Pelk with Jordal and Slider here in Kalispell. I'm a tax CPA. I primarily work with individuals, businesses. I also do quite a bit of estate planning as well.
Awesome. And Erica Dorrington.
Hi, thank you for having me today, Heidi. I am a financial advisor at D.A. Davidson in Kalispell, and I work with a team of advisors, White Peak Wealth Management, which consists of our client associate, B. Sloan, and advisors Bob White, Laura White, Zach Barber, financial advisors at D.A. Davidson, and company member Civic. We serve several clients that use charitable gifting as part of their financial plan, as well as many nonprofits that receive stock gifts. So I'm really glad to be here and talk through some of these strategies.
Very nice. Thank you. And Jim Soft, can you unmute? Yes.
I'm unmuted. Thank you. Heidi, and nice to be with you, panelists. My name's Jim Soft, and I'm the President Emeritus. That's code for the old guy with Yellowstone Boys and Girls Ranch Foundation. I'm still quite actively involved with them after 40 plus years. I'm also the principal of James C. Soft and Associates, and that's how I became acquainted with Heidi and helping her structure a few planned gifts there. So look forward to working with the other panelists. That's part of what I've done over my career is be highly engaged with lawyers, accountants, and financial advisors in the financial planning process.
Thanks, Jim. All right. Well, let's just jump right in. We have Erica Johnson. She's going to outline some scenarios, and then she's going to give us some information that we will just absolutely cherish. Thank you, Erica.
Thanks, Heidi. And hello, everyone. My role here is to, I think, give a little bit of a 30,000-foot overview of what the reasons we gift, why we might want to worry about some tax advantage or tax consequences, and advance our tax benefits for gifting, and also highlight what's happening in the near future or what could very well happen. So I'm going to share my screen here and go through a bit of just real quick. I don't have a whole lot of time. None of us do. So this is going to be a rather truncated version and an overview. But there are the four main reasons I thought of that why somebody would want to make a gift is absolutely to avoid tax and to have some tax benefits. And the main taxes that we're wanting to avoid would be the estate tax at right now 40%. Anything over the exemption. And these are some words that you might know, and I can explain a little bit more later. The income tax, which, as you know, we have marginalized tax brackets. The highest bracket right now is 37%. And we can use gifting strategies to reduce your taxable income. And then finally, the capital gains tax. And for long-term capital gain, it's 20%. However, $250,000 is excluded on a personal residence. Another reason to gift is you are philanthropically inclined, like so many people here today. And sometimes people just really want to gift to a cause or a charity, regardless of the tax consequences or benefits, but the tax benefit is an added plus. a lot of times we have other reasons that are really important to us, meaning some of us have an adult disabled child that we need to think about. And there are gifting strategies for them upon your death. A child with economic hardship that you're wanting to provide something for, a child who is in need of housing, which is sometimes difficult to come by these days with higher appreciated home prices, and college funds for grandkids. The reasons for gifting to our family members and loved ones is endless, but that sometimes that takes precedence over anything else. And finally, another reason I do see sometimes is when someone is facing a significant long-term care bill and they want Medicaid eligibility. And this might not apply to a whole lot of people here, but I just wanted everyone to know the Medicaid eligibility requires you to spend down your assets down to $2,000 with limited exceptions for a spouse, a house and a car, and an amount of cash. And then Medicaid has a lien recovery against those assets upon the passing of both spouses. So it's not ideal because it's crisis planning, but it allows a method to at least preserve something for your loved ones if you plan in advance, because there is a 5-year look back period that Medicaid will impose. So I don't want to get a whole lot into that. That topic is for another day. And finally, you might have a combination of reasons 1 through 3. And so when we have all of these reasons for gifting, we really need to get with our advisors. And absolutely, it is a CPA and your wealth advisors and your attorney to figure out what are your goals, who do you want to give to, what's the amount you want to give, and what's the reason for gifting? What's most important to me? And then we weigh the tax consequences based on the particular asset and the amount that you are gifting. So I wanted to address a little bit why there's a frenzy right now in the media considering gifting in 2021. And it is because right now the House Ways and Means Committee is considering the Build Back Better Act that Biden is proposing, and the House, it's going in front of the House. It's going back and forth as they retool a lot of the tax policies, but I just wanted to, maybe you've read about it because there's a lot of blogging and there's a lot of reporting on this. So you should be aware. Right now, as of 2021, and this is based on the 2017 Tax Cuts and Jobs Act, the estate tax exemption is 11.7 million per person and 23.4, so doubled for a married couple. That is quite a lot of an exemption. However, as I'm going to get to, that's coming down quite a bit if the law passes. So we need to plan. The law also, right now, many grantor trusts are allowed to shield excess beyond the exemption of your estate from the estate tax. However, as I'm getting into later, those will go away if it's passed. Except for charitable irrevocable trusts, which Jim will get into. And the other concept, right now we have income tax brackets, which are lowered because of the TCJA. And right now the highest tax bracket is 37%. So what's happening? What's going on with the Build Back Better Act that is proposed? Now the proposal is for it to take effect January 1st, 2022. It's still kind of an unknown, so we just really have to plan and watch. But what's being proposed is that the estate tax exemption will be lowered all the way to pre-2017 or 2018 levels, back down to 5 million per person and 10 million per couple, inflation adjusted. So that accelerates the original sunset from what was supposed to sunset in 2026 to right now, 2022. And that is why there's a frenzy about, do I gift? What do I do? How do I get under the exemption and so forth? In addition, the grantor trusts that many people typically use to shield their excess estate from tax will be, under the new law, if it's passed, disallowed. So if you have a grantor retained annuity trust, a GRUT, intentionally defective grantor trust, ILIT is irrevocable life insurance trust, SLATs, all of these, they're wonderful tools, but the proposal is to dismantle them. And income tax brackets will raise back to pre-2018 levels, with the highest income tax bracket is 39.5%. So many people say, well, will Congress do it? Won't they? And we can all sit here and think, well, we don't know. But the best thing to do is use your own history and really plan for the worst. That's what they say. You have to consult your advisors and assess your risk and what it means for you and your estate. But I thought it would be very helpful to show this chart of the history of the estate tax exemption, to show you that with my little cursor, if you can see it, we've had an estate tax exemption. Well, we've had an estate tax for as long as I can remember. And the exemption has steadily increased until we get to 2017 and the Tax Cuts and Jobs Act, and it was significantly increased. Here we are with my little cursor in 2021, and the next 4 lines show what was supposed to happen under the original Tax Cuts and Jobs Act. This is supposed to sunset and go back down in 2026. However, the new law that Biden is proposing is supposed to accelerate that all the way back to 2022. I don't think that, in my just estimation, that it's sustainable to keep such a high exemption for much longer, given that we have $1 trillion deficit, that we have lots of things going on. No matter what you think about it politically, it's just the nature of politics, is going back and forth. Taxes raise, taxes go down, exemptions increase, they go down, and it's our job to monitor and help you plan for that. So I wanted to share it with you, and I'm trying to go fast through this. One of my main jobs and what I focus on is how to help people avoid the estate tax. If it comes down, the exemption down to 5 million per person or 10 million per couple. This is an example, this chart, of a plan that estate planners have in place. It's very simplified. There's a lot of more going on the fringes, but I just wanted to explain why gifting is important. So up here in the green box, we've got a husband and wife's estate. We're assuming that it's valued at 10 million. And we're also assuming that the exemption has in fact come down to 5 million per person, 10 million per couple. Okay, the exemption is per person. So that means each spouse gets to take advantage of it. And there is portability. So you get to take advantage even if you don't have this particular plan in place. But I will say portability could go away. So it's nice to have this as a backup plan. I'm probably using terms that might be needed to be defined in some future webinar. But anyway, upon the death of the first spouse, let's just say the husband passes first, given life expectancies, we have husbands passing, then their green box estate gets divided into 2 estates. And there's a B trust. So I'm pointing over here, it goes over to the husband's estate. And we want to put assets in an irrevocable bypass trust to protect them and utilize husband's personal tax exemption. And then it's protected. Meanwhile, the rest of the estate of the marital estate goes over into the wife's. She's the surviving spouse, let's say. She has revocable trust assets, and she also has non-trust assets like an IRA, a 401k, and similar qualified retirement plans. For the purposes of this particular scenario, we've got a $10 million estate. Husband dies, we put 4 million in the irrevocable trust. It's safe and protected, and wife gets to be the trustee and live off the income. She can touch the principal under certain circumstances named in the trust. She also we put 4 million in her revocable trust or her non-trust assets. And so now the red box is designed to show her exemption protection for her assets. However, why didn't I put in 5 over here and 5 over here if the total value was 10 million? And that is because wife she's going to keep living. And until wife dies, both of the assets, both of these trusts, the irrevocable bypass trust B and all of wife's estate, non-trust assets, and her revocable trust will continue to appreciate and grow. So we have to always monitor how we are keep staying under her exemption, whatever it is in the year that she passes. So that's why I kept it at 4 for each. Well, now we've only got $8 million out of the 10 million in the total estate. So what do we do with that extra 2 million to prevent it from, that's the excess that could be taxed. So we want to put that over in this hexagon I've drafted over here, and that represents your gifting. Many strategies and ways to gift to get it out of either estate and into a different vehicle, or a direct gift, that's number 2, an outright gift to people or charities whom you want to benefit. So we're always monitoring, will Congress lower the exemption, raise the exemption, and how quickly are my assets appreciating in any given yellow box or red box, where I need to be monitoring that and figuring out, do I need to be gifting? That's what this arrow is right over here. Does wife need to be gifting assets out of her estate to keep under the exemption and avoid tax? And so this hexagon is really what we're talking about today. So going back, now we're over here. This is the hexagon that I wanted to talk about. Same that was on the last chart. So the big
Erica,
question.
you have 2 minutes.
Okay, I'll quickly go through it. Thanks.
Very good. Thank you.
And this is perfect because I've given the overview, and now the big question is, which of my assets should I gift? And is there a preferred order or strategy? And the rest of the panelists are really going to help me out and dive into that part of where we are in this analysis. But the first thing you want to consider is, first, you need enough funds to care for your long-term and elder care expenses. That should be a primary consideration. Next, do you have your more important reasons for making a gift? Because that's going to weigh in the decision-making tree. What are there charitable causes you want to support? That weighs into the decision tree. And then what are the tax consequences? And obviously we're worried about, for example, insecurities in real property. Are your heirs going to lose the step up in basis? And therefore, when they sell that property upon later, they'll have to pay capital gains tax. So that's a real something to consider. If it's an IRA, you can't gift an IRA outright. You have to make a distribution first and gift the cash. But any distribution you take from an IRA, if it's large, could push you into the next income tax bracket. And so that has to be weighed. However, but there's tax mitigation strategies. These are the most important things that I wanted to have you take away today. Your annual gift tax exclusion. If gifting is important to you, you should be using this each year and maximizing it. It's basically an excluded from any reporting of your estate and gift tax return, $15,000 per year per person, and unlimited number of recipients. So for example, you want to give 10 gifts at $15,000 per gift. That's $150,000 that went gift tax free. So that's something to really think about. Your qualified charitable distribution from an IRA. I'm sure Erica is going to talk about that, but $100,000 income tax free that you can make to a gift or make a gift to a charity. Other charitable gifts, you get a tax deduction, and Jim's going to talk about this, I'm sure. You can structure your charitable gifts in various ways to maximize and carry over the tax deduction to reduce your taxable income and taxable estate. So that's a great double whammy a double benefit that you get. General gifting guidelines really quick. Everyone says, can I gift cash? Absolutely. Cash has no basis. Gift away. Try to use the $15,000 gift exclusion. Anything over the $15,000 per year will be reported to the federal government, the IRS, against your gift tax exemption. Next, if you're gifting to family or friends, you want to gift a high basis, low gain asset. But if you're gifting to a charity, you want to gift a lower basis, higher gain asset, because the charity does not pay cap gains tax on the gift. I'm sure the other panelists will really dive into that. Then you want to just simply analyze and choose the lesser of two evils. Sometimes you've got multiple goals. For example, if estate tax is 40%, sometimes it makes sense to concentrate on estate tax savings because it's the larger tax, and be okay with some negative tax consequence that might occur to your income tax or cap gains tax. And lastly, always consult with your team of advisors. Your CPA and your wealth advisor are invaluable to help you with these decisions. And I'll just turn it over to Bryson.
Perfect. So as I said in my introduction, I'm a tax CPA, and what I've put together here is the top questions that I receive on a regular basis related to charitable contributions. So go ahead and go to the next slide. So the top questions I receive are typically it's timing and method. When should I make a charitable contribution, and how should I make this charitable contribution? Is this something I need to do in the short term? Is there a strategy to how I do this? Is this something I do from my estate? What do I give? Do I give cash? Do I give stocks? Do I gift out of my IRAs or from my other assets? So getting into the timing in the long term, go ahead and go to the next slide there. All right, perfect. In the long term, for a significant gift, you really need to ask yourself, do you want to see the results of this? When I say gift, I'm talking strictly about charitable contributions here. So do you want to see the results of this charitable contribution? You can have a charitable contribution during your lifetime, or you can have a charitable contribution or a specific bequest from your estate. The ultimate tax treatment of that is two different buckets that you're looking at. During lifetime, you're chipping away at income taxes, and if it's through your estate, you're chipping away at ultimately your estate taxes, if that applies. Post tax reform, with as Erica had explained, with our high estate tax exemptions currently, it shifts that the benefit for some people, for most people, I should say, to those contributions during your lifetime. But then the question, the common fear is, well, am I going to run out of money? I don't want to gift this during my lifetime because I've got a lot of other obligations that I need to meet, and we'll see how things pan out, and I'll let my estate do this gift ultimately. And really, you just need to work with your financial advisor to ensure the timing and you can meet your goals in terms of charitable contributions. Now, looking towards more short term, TCJA or tax reform in 2018 that raised our estate tax exemptions also had a shift in our standard deduction. So you either itemize your deductions or you take the standard deduction. With tax reform, the standard deduction was about doubled. So now for 2021, a married couple gets a standard deduction of $25,100, and what that means is we're gonna add up certain medical expenses, some property taxes, mortgage interest if you have it, and then the other major piece is your charitable contributions. We add all that up, and if we're in excess of the $25,100, well, then we've got some benefit there. With this higher standard deduction amount, it takes a significant amount of contributions before you really start seeing the benefit. There were lobbyists when tax reform was in bill form being debated that argued TCJA caused a 30% decline in the tax benefit for charitable contributions. There's some funny math going on there, but I don't know where they got that, but that's what they were lobbying for there. So in order to make sure you're maximizing tax benefits, what we typically suggest post 2018 is that if tax is your primary motivation for giving, or not, I shouldn't say primary, is a strong motivation for giving. Let's get you the biggest tax benefit possible, and depending on your situation, we may want to double up on those charitable contributions in one year and then completely pull back in the next. So the idea is I'm going to itemize in 2021. I'm going to take the standard deduction in 2022. I'm going to itemize in 2023 and take the standard. So you're planning forward, and we'll go beyond that to plan to, let's make an extra property tax payment. Let's make an extra mortgage payment. Let's bump up your charitable contributions, and then you take a break the next year. Depending on your tax situation, it could make a significant impact on your ultimate tax return. Another tool in the toolbox there you should be aware of is donor advised funds on that doubling up of donations, because you can make a double donation essentially to your donor advised fund, which you have ultimate control over. But you could donate to that donor advised fund in 2021, and that donor advised fund doesn't necessarily contribute to the charities in 2021. But it's a way to get your tax deduction and maybe smooth out the ultimate donations that go to the tax exempt entities. Also in the short term, another thing to consider is a high income year. If you've got a year where you've got a lot of income just by way of our tax brackets, that dollar that you donate in that year is worth a heck of a lot more in a low income year. So we try to match up income with those charitable contributions. This is all 100% income tax view that we're looking at here in the short term. Go ahead and go to the next slide. So when we look at the method of donations, you can do the usual, cash donation. With the CARES Act, we now have if you take the standard deduction, so if you take the $25,000 that you're automatically going to get for a deduction, you can get a deduction for $300 if you're single, or $600 married filing joint, which is something that's new. So in any given year, no matter what your technique, what you're doing, you may as well donate that minimum amount because you're going to get benefit for it. Another change from prior years is your charitable donations. If you do itemize, so we're adding up all of our donations for the year and you're going to get benefit for it, it's limited to 100% of your adjusted gross income. So if let's just say your earnings in a year were $100,000, and that ultimately is your adjusted gross income, you can donate $100,000 and deduct it in that particular year. This is up from, we've had 60% thresholds, 50% thresholds, but for cash donations, that's the current threshold. The other method of making a charitable contribution is going to be via non-cash. This would be your stocks, real estate, art, collectibles, etc. You have to hold this particular asset for more than a year or more. The deduction here equals the fair market value of the item that you're donating. I'll try to hustle up here because I know I'm running out of time.
But 2 minutes.
If it's not a readily tradable, so if it's not a stock that's traded, you typically are going to need an appraisal. So if you were to, let's just take an example, you donate $100,000 piece of land, that's the value of it, and you paid $10,000 for it. well, you're going to get $100,000 deduction. You have to jump through the hoops, get your appraisal. And do know that if you do these non-cash type donations, it is limited to 30% of your AGI. So to keep numbers round, my AGI might be $100,000 in the year. Well, I can only deduct 30,000 of that. The other 70,000 is going to roll forward to future years. So you do get benefit. Erica had mentioned the donation from an IRA, and this is something that people really do need to pay attention to if they are in a situation where they're taking their required minimum distribution. They are either age 70 and a half or 72 in some situations, and they don't necessarily need or want their RMD, and they are charitably inclined. What you do is you take that charitable rollover directly to the charitable organization, and it is not included in your income. The big deal here is you don't need to itemize your deductions to ultimately get this out of, to get the deduction, because you're not taking it into income. And there's a lot of factors on your return that ultimately come down to your adjusted gross income. If you can exclude that income, it can help out. It can boil down to Medicare rates, a lot of different things that come off your tax return. So go ahead and go to the next slide there. So just in conclusion, really quick here, with proper planning, you can maximize your tax benefits while helping those charities you really care about. I don't have time to go through this example, but this was 6-7 years ago. It was a unique situation between estate taxes, income taxes. We had a large gain. We did a whole lot of planning, and I think we met on December 1st. So we didn't have much time. In this situation, $1 million donation resulted in $900,000 of income and estate tax savings. It's a home run type scenario that you look at it in the end and you really just scratch your head and say, wow, the amount of planning we did here to do a $1 million donation and have the net cash flow be $100,000 is pretty amazing. So with that, I'll go ahead and turn it over to Erica.
Thank you, Bryson. First, I'm going to start with a little disclosure required by regulators that this material is being provided for educational and informational purposes only, and it is not intended to provide tax advice. You should consult with your personal tax advisor for advice on these consequences before making any decisions. So today I'm going to speak on a few topics that have been touched on a little bit already, but I think they're really important, so I'm going to reiterate them. Using a team of advisors when making a decision like this, how to maximize your tax property while making a charitable gift, how to make a stock gift, like the logistics behind it, and using your IRA to make charitable gifts. So on the team that I work with of advisors, we base our recommendations to clients based on their needs and their goals, which sometimes include wanting to donate to charities and reduce tax liabilities. Our team uses a planning process to help clients identify these needs and goals. And then we often, bring in the client's tax advisors and estate planning attorneys in these recommendations and the decision process. We consider tax advisors and attorneys that work with our clients part of our team and incorporate them into the processes to fully understand the client's tax implications and their tax plans and their estate plans. We don't ever want to do something that's going to disrupt either. So when it comes to financial advice, think of a three-legged stool: your attorney, your tax advisor, and your financial advisor. So how do we help you maximize your tax property? Heidi, thank you for sharing that already. It has been said that it's better to give than to receive. Well, some people might not believe in this, but it's easier to do when Uncle Sam is footing part of your tax bill. So in all my examples, I'm going to talk about, let's say that you've decided you want to make a $10,000 gift to a charity. And let's just talk about 3 different ways that you can do that. The easiest way is probably just cutting a check from a bank account, resulting in a tax deduction And then, of course, letting your tax advisor knowing that you did that of $10,000. But let's say that you own a stock and it's appreciated. Let's say you bought this stock or investment at $3,000 a few years ago, and it's now worth $10,000. So that's an appreciated stock. It's grown. So let's say you decide you want to sell that stock to come up with your $10,000. And because you only paid $3,000 for the stock, you have a $7,000 gain, in which you will pay, depending on your tax bracket, capital gains tax. So you're not really getting the full benefit of making your charitable deduction or your charitable gift. So another option is just simply transferring that appreciated stock that you paid $3,000 for, and now it's worth $10,000, to the charity. So the reason why that's probably your best beneficial, biggest bang for your buck is that the charity doesn't have to pay tax on selling that gift. You don't have to pay tax on that gift, and you get the full deduction. But let's say, you really want to own that stock. You think it's a good company. So here's just a different perspective. Go ahead and transfer the stock to the charity and use that $10,000 in your bank account to repurchase the stock. That way, you're basically stepping up your own basis, meaning you're getting a higher price for the stock, yes, but you're still owning it. And then when you go to sell it or need to use it for something else down the road, you have a step up in basis. So that's in this piece that we're sharing as well. Just a little reminder that you can go back and look at those 3 ways of gifting appreciated stock. So let's just say that you've decided on the stock that you're going to gift. You've decided on the timing and the amount, and you've kind of looped in your team of advisors. So how do you actually go about making the stock gift? So my first thing that I want to remind you is communication is key. There are 3 parts of a complete stock gift. Donor intent. So your intent needs to be that you are donating this to a charity. The donor presents the gift, and then the donee accepts the gift. So your first step would be to discuss your intent with the charity that you want to make a stock gift and ask if they have a brokerage account set up. Then you would obtain the transfer instructions to provide to your financial advisor. If the charity does not have a brokerage account set up, your financial advisor could likely help you help facilitate opening an account for that charity. Your second step of presenting the gift is making sure that your gift is documented, meaning you should receive a gift letter from your financial advisor that you would then provide to your tax advisor to make sure that you get that deduction on your taxes. And the charity that you gift to would likely send you some sort of receipt. The total gift amount is usually calculated by using the high-low average of the date the stock was transferred. So the day that you present the gift to the charity. So I'm getting through this a few kind of quickly, Heidi. So I just have one more section to talk about how you can use your required minimum distribution or IRA distributions to gift to charities once you turn 70 and a half. So a required minimum distribution is basically the IRS is saying that you've had that money tax deferred long enough. So they want you to distribute a minimum each year. So you pay income taxes on it. So a gift of up to $100,000 can be given directly to a qualified charity. So it has to be a registered 501c3. And it's not taxable to the IRA owner. This has 3 benefits that I can share with you today. The qualified charitable distribution can count towards your RMD. The distribution is excluded from your income as a taxpayer, and then it results in a lower overall tax liability. When it comes to the qualified IRA charitable distributions, always consult your tax advisor, but you don't have to worry about, stock gift or anything. When it comes to that, you can just distribute directly from your IRA. And that is all I had, Heidi.
Oh, that was excellent, you guys. We are just moving right along. So now we have Jim Soft. Jim, you are up and ready to go.
Okay, my assignment was to talk about charitable trusts and charitable annuities. And there are really 9 different flavors of charitable trusts. They're called split interest trusts, which means that the interest in those trusts, the financial interest, is both the donor and the charity. And there are 3 different flavors of charitable annuities. So that's 12 different gift instruments, any one of which requires an entire day to really understand. So we're going to try to do the impossible here and get through 5 of these different concepts in 10 minutes here. Okay, Sarah, we need to go to the next slide. Hit this. Oh, okay, got it. There we go. Okay, giving and taxes is our topic. Someone has said that to give only for tax reasons is not the best motivation, but I would submit that to give ignoring the tax implications is not the best stewardship. And so we are going to look at right kind of motivation here, as well as the proper stewardship. If I can advance these. There we go again. Okay. We're going to look at examples of tax-wise giving for all the right reasons, but first, we want to look at what I call the public policy rationale for charitable giving. Some of these gift instruments, you've heard the saying that if it looks too good to be true, it probably isn't true. And but some of these gift instruments that we're going to look at, as Bryson mentioned earlier, in that $1 billion transaction that really cost only $100,000 to give, that's a pretty attractive tax consequence and using strategic giving. But we need to know what's behind these types of incentives, lest the people think that we're working between the lines in terms of, is this legal or isn't this legal? We need to know that in America, we have 3 basic sectors. And the public sector passes laws to encourage the private sector to give to the charitable sector, which in turn lessens the burden of government. It's very important to understand, especially when we look at some of these significant tax and income benefits of these different gift instruments. I've often said that tax credits for giving, such as we have in Montana, we'll get to that in a moment, and the contribution deduction for giving on the state and federal level, it's the only deduction in the entire tax codes or the state statutes, generally speaking, where you get a tax break for doing something for someone else. All your other tax deductions and benefits are, in a sense, self-serving. Back in the day when we had statesmen back in the Beltway, rather than politicians who can't seem to get things done, they passed laws that encouraged the private sector to give to the philanthropic center. And how did they do that? Which the philanthropic sector in turn lessens the burden of government. They did that through tax policy. And we even do that on a local level. We'll look at a statute, 1530-2327, which was passed back in 1997, called the Montana Tax Credit for Endowed Philanthropy, or the METC, Montana Endowment Tax Credit. And if you look at the highlighted portion here, there are 4 of the 9 gift instruments where you can make what is called a planned gift and not only generate a charitable deduction, but if you dedicate the corpus of this planned gift, if it's a trust later, and if it's an annuity contract, the residuum, to create an endowment fund at the charity, you can generate a Montana tax credit of up to $10,000 per taxpayer. We're going to show how one taxpayer totally eliminated his Montana state income taxes this year by using one of these gift instruments called a charitable gift annuity. So we're going to look at 5 gift instruments here. We'll see the federal tax implications, and I'll comment on the state income tax implications, deductions, and/or credits. First, we're going to look at gift annuities. Charitable gift annuity is simply a contract between the organization, the charitable organization, and the donor. I had the privilege of serving on the American Council on Gift Annuities, which sets the rates for these charitable contracts. There are probably 1.2 million public charities in the United States, not counting churches, and probably only about 4,000 charities literally write charitable gift annuities. A quick ad for Emmanuel Foundation. I work with Heidi, and we do structure some annuity contracts for donors to the Emmanuel Foundation. And with Bragg at Yellowstone, we had the first charitable annuity and first charitable remainder trust, Section 664, in the state of Montana. If you're going to do an annuity, right now the current rates for an immediate annuity range from 3.9% at age 60 all the way up to 8.6% at age 90. These annuity contracts can be funded with cash. They can be funded with appreciated assets such as securities and even land, although the charitable organization sometimes gets a little squeamish on funding it with land because land is illiquid that takes time to sell, but some charitable organizations will issue an annuity contract for land. We're going to look at a contract here. I call this lady Mrs. I Am Paid. Here's a lady who wants to make a significant gift to her favorite charity, but she doesn't want to give up the earning power of this $10,000 of cash. She had maybe a CD that matured, and she looked at the rates that banks are offering these days. There's not much benefit to re-upping a CD, so she talked to her local charity, and the charity said, hey, we can offer you a 5.4% charitable gift annuity. And if it's funded with cash, quite frankly, most of that income will be tax-free. Roughly, in this instance, about 82% of that income would be tax-free. So this 75-year-old lady transferred $10,000 to Emmanuel Foundation and said, pay me 5.4% a year for the rest of my life. Her benefits, she had an immediate income tax deduction of $4,587. If inside that contract there was language that said the residuum of this contract, meaning what's left after the lady goes to her reward, is dedicated to a permanent endowment at the Emmanuel Foundation or at Yellowstone, as the case may be, you'll be entitled to a tax credit for 40% of the allowable federal deduction, not to exceed $10,000 per taxpayer. So this could generate a tax credit for this lady of about $1,800, which is a direct reduction of her state income tax. We won't take the time to get into the SALT implications, the state and local tax implications that came in subsequent to the Tax Cuts and Job Act. There's a good chance that in this current legislation, which is being bantered around, the SALT penalty may be removed, so we're not going to take time to discuss that. So let's just look quickly at the benefits. She had immediate income tax deduction of $4,587. She turned $10,000 that was earning her probably about 0.5% at a CD into a 5.4% payout, with over 80% of that being tax-free. We see that amount, $436, tax-free for her current life expectancy. And then after she lives out her current life expectancy, 12.4 years, according to 2000 CM mortality tables, she continues to get her annuity income, but it becomes fully taxable at that time. I've had annuity clients who've lived to be 106 years old. So if you want to have immortality, buy an annuity from Emmanuel Foundation or from Yellowstone. The charity will receive the remaining principal once the annuity has matured. We're going to look at a deferred annuity, another type of annuity contract. Here's Mr. I.L. Waite. He is 60 years old. He says, I want to keep working till I'm 75, but I would sure like to harvest some income tax benefits tied to a future income stream. So he transfers $50,000 to his charity of choice. They issue an annuity contract that will pay him 8.6% for the rest of his life, starting at his age 75. Because there is a deferral before that income starts, he generates an immediate charitable income tax deduction of $26,712. If he builds in endowment language in that annuity contract, once that annuity matures and goes into the endowment fund of the local charity, he will generate a Montana tax credit of $10,000. So if his state income tax bill for the year in which he does this contract is $10,000 or less, he wipes out his state income tax bill. Just a little sidebar here. Former Governor Mark Roscoe one morning decided that Montana has to do something to increase endowments in charities in Montana. So he convened a task force, which I had the privilege of serving on, to come up with some tax incentives that would encourage endowment development. And the Montana Endowment Tax Credit was the product of that task force, which that tax credit has been with us indefinitely. It sunsets, but it's been renewed 5 different times, and it looks like it'll become permanent. So, Mr.
Jim, you have
I.L.
2 minutes.
2 minutes. Okay, we
Thank
really
you.
have to hustle. Okay, now we're going to look at a charitable remainder trust. And what that simply means is the charity gets the remainder once the trust has run its course. Here's Mr. and Mrs. I Am Done. They are done farming. By the way, all of these are actual case histories. The names have been changed to protect the guilty, and the numbers have been rounded off for easy presentation purposes. This couple wanted to quit farming. They had a piece of ground worth $500,000, $75,000 basis. If they were to sell that, they'd be paying capital gains tax, state and federal, of 25 to 28% if you throw in the Obama tax, because they had been leasing the ground for a few years, so it was passive. They avoid all of the capital gain, which would otherwise be around $125,000. They excluded the gain of $425 and avoided the tax on that. They'll take back an income for the rest of their lives, in this case, a 7% payout, and they will be entitled to a charitable income tax deduction of $117,665, in addition to avoiding the capital gains tax. So this is an excellent strategy for people who are charitably minded, want to increase their cash flow. They take what I call a lazy asset that may not be generating a lot of money and convert it into a 7% income stream. At the end of the trust term, which means the end of their life expectancies, in this case, the trust matures and goes to charity. This is a charitable remainder trust, meaning charity gets the remainder once the trust has run its course. Conversely, there is such a thing as a charitable lead trust, which means the charity gets the lead interest and family or the donors get the remainder interest. This is a live case which was recently done. The numbers were a little different here, a little higher than what we're showing here. But here's a gentleman who sold his business and incurred a very, very significant tax as part of the planning process. He decided to put $1 million into a charitable lead trust, which would pay charity $70,000 a year for 17 years. And at the end of the 17-year period, that $1 million would be returned to the donor. It's called a grantor lead annuity trust. The individual, by structuring the gift instrument in this fashion, will receive an income tax deduction of $1 million in this year in which he had the significant taxable event from the sale of his business. So he gave $1 million away vis-a-vis a lead trust, $70,000 a year to charity for 17 years. And he gets his $1 million back plus whatever it may have grown to inside that trust. In this case, I have projected a 7.5% total rate of return inside the trust. There's an interesting tax issue here where the grantor has to report the income activity of the trust during that grantor term. However, with very capable investment strategy, that can be kept to a significant minimum. If the same individual would have structured a non-grantor lead trust, facts and circumstances all the same, but at the end of the 17-year term, the $1 million doesn't come back to the grantor, it goes to the family, children, or significant other. They would receive $1,161,000, assuming 7.5% total rate of return along the way. And there would be no income tax deduction, but this would get the $1 million asset out of the estate, just as Erica was talking about earlier when she was talking about the hexagon box. I think that was Erica. So
Okay,
anyway, these
Jim?
are 5 different strategies. Talk about a flyover. This is about 100,000 foot flyover. All of these have significant technical I's to dot and T's to cross, but they're very doable and require working with financial advisors, investment advisors, CPAs, and so forth. So these are all real live cases. This is not textbook academics. This is real stuff. It does work. And it's a wonderful way to encourage your donors by reducing taxes and increasing cash flow in many instances, and to put in place some significant gifting to charity of choice. Back to you.
Excellent. Yeah, thank you, Jim. That's wonderful. Okay, so would all the panelists please unmute? We have we had one question. I think we would have had more if you weren't all so thorough in your presentations. There was a question that said, if I donate property, is there a way to donate my property if I still want to stay in my home?
Is the question, is there a way to donate my home?
Yes, my home, and still live in it until I pass.
Yes. What you're talking about there is a charitable life estate, and a person can convey their home to charity. Simply a deed. You go to Erica Johnson, she prepares the deed, and she reserves in that deed a life estate for the individual. Very large charitable deduction. And in this very low interest rate environment that we're in, I'm going to say a $250,000 home donated to charity for a 70-year-old individual would probably generate $175,000 charitable deduction, which they could use over a 6-year period. You have to use as much as you can, as fast as you can. However, there's also another technique that is being used. It's somewhat like a reverse mortgage, although it's a lot more beneficial than a reverse mortgage. You can donate your home, live in it for the rest of your life, and receive an annuity. Not too many charities are doing this in Montana because, again, it's kind of a negative cash flow for charity, but it is a very strategic charitable financial planning move that can save taxes for the donor, increase their cash flow, they get paid for living in their home, and put in place a very generous future charitable gift for charity. So that's called a charitable annuity life estate.
Thank you. Wow. So I think we need to have a couple more webinars just on some of these particular topics, but I'd really love to just thank all of our panelists. You guys are just absolutely fabulous. And to our attendees, if you have questions, consult and ask your team of advisors, CPAs, certified financial planners, wealth advisors. This panel here was just absolutely amazing. So thank you all so much. And I'm just so grateful to you. and enjoy the rest of your day.
Thank you.
Thank you.
Thank you.